that when the next person will look that much better. But me having to follow Don is not an enviable position, and I will try to get out of Don some Vegas details for all of us. I have some other people who are going that we have friends in common that like a little detail. So good evening, everybody. Greg McDermott with Cyber Trading University. We are going to get going with the presentation in 1 minute. The slides are going to get loaded up, and we will get ready to record this presentation for you. Looking forward to following up on Don's talk about the Trade Monster platform and the ability to trade options, so that we can kind of go. We're going to take a step backwards. And what Don talked about was, you know, if you were trading options, how would you do it? We're going to go back and sort of look at where did the options come from. You've all probably heard of the Blackscholes Model. You've heard of option Greeks. What we're going to try to do tonight is give you a little bit more information about how options trade, why they do what they do, why those trades, the chart that Don showed you, the profit and loss, like how does that differ? And we're going to touch on that very early in the presentation. How does it differ from trading stocks or trading futures or trading currencies? How does that P&L graph look different than when you're trading options, and what can go right and what can go wrong? So we're going to get into that, and I'm looking forward to it. I think it's going to be, I enjoy talking about options. Some of you may know me as the FX guy from Cyber Trading University. I was an options trader on the floor. We'll get into that as we get going. So I know everyone's got had a long day. I don't want to push this any longer. We will get going with the presentation. As always, the CTU risk disclaimer. One day I'm going to read this whole thing to everybody, but for the moment I am going to remind you that there is a high degree of risk involved in trading, and past results are not indicative of future returns. Let's let you take a minute to read the rest of that. I'm sure you're all very, very familiar with it. And as we move down, about Cyber Trading University, CTU has been an educational trading institution since 1995. We established ourselves as a leader first by working directly with the SOES trading firms to teach them how to day trade. CTU was one of the first schools to establish itself as a quality stock market trading school. Each of our instructors, yours truly included, has a minimum of 6 years of actual trading experience before they begin to work with students. Over the past 14 years, we've taught thousands of students to be successful and profitable traders. And the CTU headquarters is located in the heart of the trading world in New York. As I always say, my mother's favorite slide, that's me. Earned a master's degree of applied finance at Macquarie University in Sydney, Australia, way back in 1989. Everybody always asks me, why did you go to Australia? And I said, well, because I had a scholarship and it was free. I recommend anybody can go to graduate school in Australia for free. Do it. Was very, very lucky. A BS in financial management from St. Joseph's University, was a crude oil options clerk and trader at the NYMEX, head options market maker for JAS Securities at the PhilX, managed our firm's portfolio of risk on the floor for a team of, at our high, 10 options traders. I was a market maker myself in the Dell Computer crowd, which at the time was the busiest equity options traded in the country. Directed an off-floor trading unit for JAS and was qualified by the ISE as a DTR. Enough about me. Let's go talk some options. We are offering tonight the ability to extend that trading summit that we had over the weekend pricing. We're going to come back on the 25th and 26th of the month, 2 hours each night, 5:30 and 7:30 on each, the 25th and the 26th. We're going to talk about options. We're going to go well beyond what we talked about tonight. In fact, after some of the information, some of the questions that we saw over the weekend at the trading summit, we modified the class. I took gamma trading out of it. That probably could be a standalone course all by itself and a little bit too advanced. There was lots of questions about debit spreads, credit spreads, calendars, verticals. So we're going to talk about those. You heard Don just mention those type of spreads. And it's really kind of the first entree going beyond simple call and put buys, or how do I do a spread. And we're going to kind of demystify the whole credit spread versus debit spread. That's going to be part of it. It's going to be 4 nights. But in addition to that, you're going to get the 4-hour live course with a year access to our recorded options. You're also going to get 1 month's access to the cyber group, which in and of itself is worse than $97 to be able to sit and watch Fausto and the team trade from 9 till the 4 o'clock bell live, watching their screens up, is a great, great value. So you follow that link. We just threw it up on the screen there. You can follow that link to get our promo pricing of $97. We will throw this slide up at the end of the night, but let's get to the good stuff. Options as derivative instruments. And this sounds like the start of a very boring paper somebody wrote. Hopefully it's not. I want to make sure everybody understands what options are and what is a derivative in its simplest form. What's a derivative? In this case, it's a financial instrument whose value is derived from the value of the underlying instrument. So the value of Apple options are derived in part by the value of Apple stock. So the value of a collateralized debt obligation, a CDO, is in and of itself derived partly by the value of the debt underlying that derivative option. An option, a call option or a put option on crude oil futures, their value in part, what is that option worth, is derived from the value of the underlying. So in and of itself, the value comes from something else. It also conveys no direct ownership of the underlying instrument. Now, it can be converted into ownership in some situations, depending on the type of derivative instrument that you have. For our discussion tonight, we're going to be talking about equity options. So in that context, if you own call options, you do not own the stock, for example, of Apple. You could, but the option in and of itself conveys no ownership. And to me, one of the key pieces, I think trying to move people from the linear trading of equities to what I like to talk about as the three-dimensional movement of options is really an important factor. If you remember the last P&L box that Don just threw up on his example, you notice that the profit and the loss were not mirror images of each other. And there was not a one-for-one profit or loss. So it's not that simple zero-sum game that you have in equities. If you own a stock and it goes up $1, you would make $1 per share of stock, and the person who sold it to you would lose $1 per share of stock. Again, very simplified, all things equal, as many qualifiers as we come up with. But in the three-dimensional world of options, we could have an underlying move that same dollar, and depending on a number of factors, including time to expiration, the strike, and most importantly, the volatility of those options, the buyer and the seller of a particular options contract may themselves see one is a zero-sum game, one wins what the other loses, but the movement will not necessarily match exactly the movement of the underlying. So it's a concept that's hard to get your hands around. The example I always like to talk about is when trading back seemingly 100 years ago, back in Dell Computer, we would get to earnings, and our earnings would always be a very big deal. And a lot of people would want to jump in and buy. Most times in Dell, everybody figured the earnings were going to be up. So the buyers would be coming in, particularly the last day. Earnings were usually announced at 4:15, end of trading, and you would get call buyers all day long. And for example, if the stock was trading at $29, you would have lots and lots of people buying the 30 calls. And as traders on the floor, we would be selling those calls at, I'm making up a number, say $1.50. Then during the day, stock moves up a little bit. We're selling them at $2. We're selling them at $2.25 without really the underlying moving, just the volatility increasing. And we're hedging those by buying stock, and a lot of times doing them one-to-one. So what does that mean? The next day, in our example, stock was trading at 29. The call buyer bought the 30 calls at $2. Well, stock opens up $3 to $32, and that call buyer's thinking, man, I'm going to be rich. I hit it right on the money. And those $2 calls open at about $2.75, and they're saying, well, wait a second. The stock was at 29. I paid $2. Stock goes up $3, and my calls only go up 75 cents. How's that possible? and it's because of the implied volatility moving out of it. If you hedge them like we had occasionally, 1-to-1, you effectively had sold puts and could make money. But that's the three-dimensional piece, trying to grasp volatility when pricing an option. And we'll talk about that towards the end of the presentation. Just so we're clear on the basics of terminology, when we're talking about options and as we move towards understanding how does the Blackscholes model give us, at least at its base, or how did it show people how to begin to price options more effectively and accurately. If you wish to use your option that you own, you would submit an exercise, or you go to your broker, or in some case your clearing firm, depending on whether you're a market maker or not. You would provide exercise instructions to your brokers. You would have to be long the position to exercise, which means you're going to exercise those options at whatever strike, at whatever month, for whatever your underlying would be. The opposite side of that is if you are forced to buy or sell a stock, again, we're going to stick to equities as our examples, you are then assigned. You have a short position, you would get assigned. So when someone wants to exercise their call, the opposite side of that trade is assigned, and that goes back to rights and obligations, which are going to come up in a minute. There's also two types of options that are traded. American options give the owner the ability to exercise at any point up to expiration the rights that they have purchased. European exercise can only exercise at expiration. The underlyings you'll find most commonly that you would see that are European exercise are, for example, the NYMEX PHLX world currency options that correspond to the world currency futures. Those FX options are European exercise. I believe that the ISE's FX options are also European exercise, which means you can only exercise them at expiration. And again, as we note here on the slide, all equity options for stock are American style. Why is that? Because the stocks can have dividends, and those dividends can influence the value of the option and put them in a place where at some point you may want to exercise your options early, convert your options into stock, and allow you to capture a dividend that is payable. When you're back to exercise, strike, and strike price, if you exercise your option, you pay the strike price for call options or receive the strike price for put options. So when we're talking about exercise price, it's also the same as the strike price, which is known in the contract and well established when you trade. Also, expiration date. When do these expire? Now, since I traded on the floor, they've added, we used to have leaps, which are long-term options, which usually were January, a year, and 2 years in the future. We now have weekly options, which effectively allows you to have expiration week every week, depending on the options that you trade. But the expiration date for normally traded equity options, not the weeklies or the minis, it's the Saturday following the third Friday of the month. A lot of people will tell you that options expire on Friday. It's untrue. The only reason I'm quite sure of that is because I spent many Saturday mornings at the American Stock Exchange, at the Philadelphia Stock Exchange, and at the New York Mercantile Exchange, making sure that all of our options settled properly so that we didn't have any unforeseen positions. The old joke at the New York Mercantile Exchange, because with crude oil, as an example, crude oil settles to the physical market. If you're Exxon and you own calls and you exercise those calls on expiration, you would then probably be taking delivery of crude oil to whatever method, and there's a delivery method set by the exchange as to where you can deliver and the type of crude and all those sort of things. But my boss used to send me in the third Saturday of every month, and my job was to make sure that we didn't screw up and have a tanker full of oil being delivered to his house in New Jersey. So we had to make sure that everything settled out properly. Your last day to trade any of these options is the third Friday of the expiration month, but the options expire on that Saturday. And let's talk about the other term that sometimes throws people off, and the title there being, how can I be long and be short? Well, long and short are terms that if you're speaking about equities, are interchangeable. If I am long, I own the stock. If I am short the stock, I've sold the stock. Also, my profit runs the same way. If I am long, profit is to the upside. If I'm short, profit is to the downside, all things being equal, just as a reference. But when we're talking about options, long and short refers to ownership. So if you are long an option, you've bought the option. If you are short an option, you've sold the option. But you can also refer to long and short in reference to direction. So long means you profit on an upside move. Short means you profit on a downside move. So how could I be long and short? Well, if I'm long a put, I would be long because I own it, but I would be short because my position would profit for a downside move. How could I be short and be long? Well, if I'm short a put, I could be, I've sold that put, but profit for me would be in a long or up position because of the P&L graph. So make sure you understand that when you're talking and you hear us talking, options are different than equities because of this. You can be long and short at the same time. Let's talk about the basics, the calls and the puts. And the most important piece I've highlighted in red. I do like that red paint stick on the PowerPoint. The owner of a call, a long call, has the right but not the obligation to purchase the underlying security at a specific price until expiration. And the key there being, when you purchase a call or a put, call in this example, you have paid a premium to have the right but not the obligation. You hold the cards. You decide when and if this option is ever to be exercised. You know when it's going to exercise because you have the expiration date. You know the strike price or the specific price at which you can exercise, and you know the underlying security. All those drive the price of the option, but the owner of the option has the rights. The other side, the seller, who is short the call option in our example, has exchanged their rights for a premium and now only has an obligation. They must sell the underlying security at a specific price until expiration for a specific underlying security. So regardless of where the underlying goes, they are obligated to sell. So when you think about that, you've got a seller who, let's give an example. They sell a July 25 call in a stock, and they do nothing else. They're just short that call. And great news comes out. The company that they sold the stock in has cured cancer. Thank God. Wouldn't that be great? Just got done helping out at the Relay for Life, our local one. What a great organization. Our Cancer Society is running that. But if the stock goes to 100, you're still obligated to sell the stock at 25 and lock in a gigantic loss, which is one of the reasons why we will talk about. You'll never hear me in anything other than an expert level, fully capitalized, go in with your eyes open class. I'm never, ever, 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 ever going to put you in a position where you would be net short options or what we would call naked options because of the risk inherently involved in that trade. So you have an obligation regardless of where the underlying goes, and that can be scary. Trust me, I've had short positions. They will make you gray. You'll make you lose sleep, and they might make you start drinking if you don't already do that. How can you think about a call option? If you're still unsure, the nice, easy example I like to use is think of it as, the coupon. Would you pay, in this example, if pizzas are selling for $15, would there be an immediate benefit of value to owning a coupon that allows you to buy a pizza for $10 good till the end of this year? Yeah, there would be. There's value there. In this example, well, how much value? Well, you're saving $5, so if there was no other way to buy pizzas and this was the only option the only coupon you could find, you might be willing to pay $1 or pay $2 to have the right to save yourself a couple of dollars because the intrinsic value of the underlying, the exercise price is going to be 15. Just a real simple way to think about if the idea of a call option kind of throws you, think about it as a coupon. You own the right. You get to do what you want with it. The pizza shop on the other side, they're obligated to sell the pizza at $10 because they put this coupon out. Maybe taking in a premium, maybe not, but they are the seller, therefore obligated to sell below what we see at $15 is the current market. So here's what a long call P&L looks like. If you graph a single long call, and I'm going to change my thing here, what we know about this just by simply looking at this P&L graph is we know that they paid $4 for this call because there's the $4 and there's the line. So we know that that's our maximum loss. We bought a call. We paid $4 for it. The most we can lose is $4. We also know that the strike in this call is 50, and that our break even is therefore, at that point, $54. Once this stock rises above $54, you're going to hit profit. So this is the area at which, in the middle here, where you move and start taking back some of that $4 premium that you paid out. So it's a limited risk. We can only lose, in this example, the $4 we put in. And I want to talk about that. Warren Buffett famously called financial derivatives the weapons of mass financial destruction. And far be it from me to argue with Warren Buffett. But when used properly, particularly for retail investors, when owning options, they can be a very risk-averse, and I'll say that again, a very risk-averse investment strategy. If you bought this call for $4 and you bought 10 of them, so you would have paid $400 per call for 10 calls. The most you could lose is $4,000, regardless of what happens. It doesn't matter. You can't lose. But let's say you owned the stock here right at $50. It's trading at $50 today, and you had a choice between buying a $4 call and just being long the stock, and you put a stop loss in at $46. So you would guarantee, you believe yourself to lose only $4. And some people might say, well, that's exactly the same because my stop loss is at 46. And if the stock goes there, then I get out of the trade and I'm protected. Well, the big difference between owning a call in this case and owning the stock is that if the stock opens at, and I'm going to put it over here, the stock opens at $10. The company, we thought they cured cancer, but guess what? We were wrong. They caused cancer, and it opens at $10. Now, again, that news came out overnight, so the market's closed. The next morning, the first print on the stock is $10. On the 10 calls that we paid $4 for, what is our maximum loss? As I poorly draw it with my little mouse here. Not pretty, but $4,000. We lose everything. We lose all of the premium that we have. But if the stock is at $50, our stop loss is at $46, and the first print is at $10, where do we sell our stock on our stop loss? Does anybody know? In that scenario, your stop loss is at 46, stock was at 50, the first print on the bad news is $10. Approximately where are we selling our stock? I will put it right here for you. Wow, that's really poorly drawn. Let's do that again. That wasn't for effect. That was just really bad drawing on my part. Let's close this up. put that here, $10. No, less loss, William. We can only lose, the stock trades at $10. So if you had 1,000 shares of stock that went from 50 to down to 10, that would be a $40,000 loss. You would have a $40,000 loss versus a $4,000 loss. You're on the hook dollar for dollar. The idea with the options is it's much, much, much safer, particularly as an owner of the stock. I mean, as an owner of the option. So that's our P&L. The beauty is we're automatically stopped at $4. All we can lose is what we put into the trade. They can't come back to you and ask for more money once you've lost your $4. Now, if you're the other side, if you're someone who sells a call, your maximum profit in this same scenario is this $4 right here. That's your max profit. Here's the $50 strike. And as the price of the underlying goes forward, you begin to lose, and in theory, put yourself in a position where you could have an infinite loss. Now, I've yet to see a stock go to infinity. I know some of them feel like it occasionally, particularly if you ever short them. But in this case, being short the call, you would take in $4 and max profit, but your max loss is astronomical, which is why we're going to keep you away from being net short options. So what happens with the puts? Exact opposite side of the coin, but this is the one people always seem to have trouble grasping. It always seems difficult, but the owner who is long a put has the right but not the obligation to sell the underlying security at a specific price until expiration. And the seller who is short the put has the obligation to buy the underlying security at a specific price until expiration. And what normally happens in the market, particularly in a case of sort of a panic, puts have a tendency to explode in price. Rarely do you see an upside panic in a stock, in an underlying, but you can see a downside panic. And when that happens, people who are long will scramble for cover at whatever level they can find a seller. In this case, if you're short puts and you've got to get them back, trust me, as a guy who's had to do it, it can be a difficult thing to do. So the exact opposite of what we had with calls. In the puts, you have the right to sell your underlying, regardless of how low the stock goes. You get to sell it at the strike price. So it gives, most times people think of puts, and here's what I'm going to show you. Car insurance is an interesting way to think about it. So think about, you buy a new car for $20,000, you pay Allstate or Nationwide or Geico or whatever the flow, whoever she works for. You pay them your monthly premium, and your car gets crushed by a boulder. Everyone is safe in my example. No one was hurt, only the car. And your car is destroyed. Well, because you have insurance, you can give them back or put back your car to the insurance company, and they will replace it with $20,000 or a new car, depending on your policy. But most commonly, people will use puts, like to use puts, rather than necessarily trading them. They always, first time they think of them as insurance or options trades. I mean, for stock trades. And you can think of it as an insurance policy. It protects you from loss on a downside move. So we'll get into this more. I'm just trying to make sure everybody has kind of a high level, the difference between puts and calls. The P&L laid out exactly like the previous, except where do we profit? We profit on the downside. So again, we bought this put. So our max loss, $4, because we paid $4. That's the distance between this line and 0. The strike is 50, and right up there, our max, where we begin to make profit, is $46. 50 minus the premium, 46. And as the stock price goes down, our profit goes up. We're long these puts, but we have a short position on. This is how we could be long and short. So this puts you into a profit to the downside, something that's uncommon. And a lot of times people have trouble grasping that, coming from the world of stock where up is good, down is bad. because almost everybody owns stocks. You know, not everyone, but mostly everyone, particularly retail investors. You buy a stock and then you sell it when it goes up and you make profits. So it's can be counterintuitive to deal with puts, because when the stock in this case goes down, your profit goes up. And if you look at the seller of the put, has the opposite position. They're taking $4 in premium. Everywhere above $50, they get to keep it all. They get $4 in their pocket. Why is that? Because if the stock is at 41, no one's going to exercise the right to sell the underlying at, if the stock's at 51, no one's going to exercise the right to sell the underlying at 50, when they could just go into the market, and that's the difference between exercise and assign. If you have that option, you could exercise it, but you're not going to, because if you wanted to sell stock, you could just sell it in the market at $51 rather than exercising your puts and being able to sell them at $50. I mean, I'm sure everyone on this call would rather have to sell their stock at $51 rather than $50. I'm sure we may not all be able to agree on some things, but I'll bet we can all agree on that. So the seller of this put, again, part of the reason why you don't want to put yourself in a naked short put position is that as the underlying price decreases going this way, your profits go down significantly. And the one thing that I just know from experience is that if an underlying moves down hard, you know, a big sell-off, inevitably you'll get a rise in volatility. And one of the other three-dimensional problems with being short puts is that you're also short volatility. So if the volatility goes up, it's like an override on your loss. Not only losing directionally, but you're also losing on your volatility. You're short volatility in a rising volatility market, which goes back to our idea of that three-dimensional P&L that can work for you, or in this case, would clearly be working against you. Clear this stock. Let me clear that off for you. Who's out there in the market guaranteeing that when I do a trade with somebody else, I can execute the trade? And what's the importance of that? Well, the OCC, the Options Clearing Corporation, guarantees performance on all contracts. That means if you wish to use your coupon to buy or sell a stock, you can be assured the transaction will go through. Why is that important? Because most times, most people do not just perform one options trade and then that's it. As a floor trader, I would have had significant positions across stocks, months, strikes, expirations. So I would have positions all over. And on balance, that position would be managed as a portfolio, but each individual piece made that up. And if I was concerned about the counterparty risk, the risk of the other person guaranteeing and living up to their obligation in our transaction, the financial market individually and as a whole would cease because of the risk involved. Someone's got to be there to guarantee that the movement of funds and the execution of the contracts will happen regardless of the solvency of the participants. And where did this come into play most recently? 2008, when we had the financial crisis. The biggest piece of the puzzle, I believe, for the too big to fail, and by the way, all of that was really well done in Michael Lewis's book, The Big Short. If you're looking for a great book, go to the library, go to Amazon, pick up Michael Lewis's book, The Big Short. I have his new book, Flash Boys, sitting right next to me on the floor here. I just haven't been able to find the time to crack it yet. But Michael Lewis's book, very good. What happened, the big piece, you heard that the term too big to fail. Well, part of the reason those firms were too big to fail was the interdependency upon each other of their financial solvency. Because, for example, if you default on one of the bank's defaults on their obligations, it may limit or prevent the other party to that transaction of executing their obligations and executing their rights and fulfilling their obligations, and the domino falls. Here's a simple example. Back in the old days when I traded on the floor at the New York Mercantile Exchange, in fact, this was when I was a clerk, every year NCAA tournament, which everyone loves, it was 64 teams back then. And they would sell, as you would expect, there'd be some gambling going on the floor of a trading at the New York Mercantile Exchange. Well, the futures were, just like you can buy in Vegas, the futures were traded on the floor, completely unregulated. And the idea was if you bought a particular school in the tournament and they won the tournament, you got $64 for every one of the futures contracts that you own. And there would be guys out there trying to sell a basket of teams for more than $65, thereby, in their minds, locking in profit. So here's an example, and here's why I didn't participate. Let's say by some miracle St. Joseph's University, my alma mater, was in the NCAA tournament, and they were a long shot, and I was able to buy one future for $2 from someone on the floor. And by some miracle, the Hawks end up winning 2 games, and they make it to the Sweet 16. Well, now the market is 8 bid at 10. Hey, they're like a 6-to-1 underdog. They're 8-to-1 underdog. There's a chance they could win this. Well, I decide instead of riding it to the end and having to sweat it, I'm going to sell the future that I bought for $2 is now $8 bid. I'm going to sell it to another clerk for $8. And again, by some miracle, St. Joe's wins the NCAA tournament. So now, the gentleman that I bought my $2 future from comes to me and says, Greg, I don't have the $64. Sorry. And I'm like, well, but wait, I sold yours to this other guy. And the other guy comes to me and says, well, Greg, I paid you $8. I want my $56. And I'm saying, well, yeah, but this guy owes me. And he's like, I don't care who owes you. You owe me 56. And that puts you in the middle of counterparty risk. In theory, those kind of trades could work, but either I just didn't have any money, which is probably more the case, or I was too concerned about the counterparty risk. That's what the OCC prevents from happening. They make sure that I can get my $2 future, and I can sell it at $8, make my $6, and move on, and then all the trades settle and clear properly. So they perform a valuable function. It's really a big deal behind the scenes you kind of forget about, but it's one of the beauties of trading options is you guaranteed performance by the OCC. So effectively, the best way to manage stocks is by options, as you can go long and short. William, that's probably an oversimplification, but it is a way in which you can be long or short equities and attempt to minimize your risk. The Blackscholes Model, brought to us by Fisher Black and Myron Scholes, introduced in their 1973 paper, The Pricing of Options and Corporate Liabilities. The Blackscholes Model was the beginning model that allowed the accurate pricing of options. Since then, there are, I'm sure dozens, if not hundreds, if not more, different models that will calculate for you, some proprietary, some available, the expected value at any point in time of any option, whether it be on equities or futures or currencies, any of those things. But the original paper from 1973 that model was used to determine a way to hedge the options using a ratio of the underlying securities. Again, taking that delta or hedge ratio, which we're going to talk about in a couple of minutes. So they were trying to figure out how can we lock in profits or minimize risk for options positions by trading the underlying stock against it. The assumption in the Blackscholes model, which is part of the reason why we now have more advanced models, more computing horsepower in general, they assumed European exercise, which is not the way equity options expire now, that the risk-free rate and volatility remain constant. Well, the risk-free rate remaining constant is probably not too big a stretch. Rho, the Greek for interest rate risk, is not normally that significant in your options position. But volatility remaining constant is a bit of a stretch. Trust me, as a guy who stood on the floor, volatility seems like it changes moment by moment. So that, again, a big assumption. Stocks pay no dividends, which we know is not true. Markets are efficient. Please, no snickering in the crowd if you're one of those people like me who sometimes question the efficiency of our markets. So that's what we built this on. That was the first step in accurately pricing options. Now, for those of you who don't like math, please get out a brown paper bag if you're hyperventilating here. There will not be a test at the end of this. I will not be asking you to redraw the calculations of the call and the put for the Blackscholes model. Why this is here is just to show you that the majority of the pieces of this model are relatively simple. We know the time to expiration. We know the spot price of the underlying asset. We know the month and strike of the option we're talking about. We know the risk-free rate, and the standard deviation, the cumulative distribution function of the standard deviation is not, although it sounds really complicated, is not overly complicated. I say that as a guy who doesn't have to calculate it, admittedly, is not an overly complicated function. The piece of this puzzle that is the art as well as the science is the volatility. That's the piece that moves. That's the piece that drives the three-dimensional nature of options pricing that I talked about. That's the part that's hard to nail down. And that's the part we'll probably spend the most time in our classes in phase 1, phase 2, and phase 3 of options trading. It kind of always comes back to what's the vol. What's the volatility? What sort of risk do we have the volatility? Are we trading one volatility versus another? That always comes up. And it's the hardest to gauge. I can remember having, my boss when I was a clerk in the crude oil pit, we used to have to do trading sheets, literally, physically. I'd walk to the back of the floor, type in our positions into an old computer, and it would spit paper out with trading sheets and just numbers and figures, and then I would go hand them, and we would change the volatility, and my boss would hand me a piece of paper that said, like, here's what I want you to do to the volatility, and I'd have to go in and manually adjust the vol. So it's the piece. He never went in and said, hey, change the date. We knew the date. Hey, change the spot price. We knew that. We knew the strike price. We knew the time to maturity. It's the volatility where the science turns into a bit of art. What does the Blackscholes model give us at its basic besides a way to value options? It gives us a relationship that allows us to see the interdependency of price between puts and calls and the underlying stock. So if we have this three-sided position, we effectively have, again, slightly oversimplified because there is a minor wild card in here, but I'm not going to get involved. But in general, if you are long stock, long a put, and short a call, you have a zero risk position. If you map that P&L, there is zero risk at that strike for that position. And what does that mean? Anyone who's taken first-year algebra knows that with an equation like that, a little bit of dancing left to right, and we can probably find some relationships that may help our trading. So what would those relationships be? How could we create a long call? Well, that's an easy one. Just grab this short call here, run it to this side, and what do we have? We've X'd this out. We now know that long stock and long a put will perform the same as a long call. The profit and loss graph will look for those nearly, if not absolutely, identical. It's going to look exactly the same. Another view of this, if you're long stock and long a put, you must be long a call. How would you do the opposite of that? You would end up being short the call. So any one of these three pieces can be created synthetically by the other two. To be long stock, to be long a put, or to be short a call. You can create all of those. So for example, here's the P&L for a long call. This is being long the call. This is being long the stock and long the put. Sure look the same to me, and that's what they are. Again, based on the same strike and all those, but that's exactly what we show you. The risk, and knowing that can help you when managing your position. Sometimes you might want to turn long stock into a long call or any other, depending on what's going on in the underlying. that flexibility comes in with being able to use the three-dimensional nature of options. So what is a synthetic naked put? How would you be short a put? Well, we all know that if you followed algebra, you would subtract from a P from this side and put it over here. This gets knocked out. What do we have? Long stock, short the call is the same as short the put. So just under there. So that's how we could create a naked or a short put position. If we had a long stock short call, we have a naked put P&L. So let's think about, when do you hear people talk about long stock short call? A covered call. A covered call position would look similar based on strike and underlying to a short put position. So if we erase these and move forward. So what's that P&L look like to show that we're not kidding? Sorry, we'll go past this one. Here is, this is, now it's long stock and short the call is going to give you the same as a naked short put position. You're capping your upside potential with a seemingly unlimited downside. So that's what we've got similar. Because of the Blackscholes model and that basic relationship, we're able to create one to the other. And that's where options get really interesting, where you can put together positions. And there may be reasons why in a particular underlying you may want to be, for example, short. You may want to have a synthetic short stock position rather than a real short stock position for a number of reasons, and short downtick rules and hard to borrow, and any number of reasons why. So it allows you the ability, the flexibility to move around your position and put in line for profit. Now here, if we wanted to create synthetic stock, well, we got to get the put and the call on the other side. So what happens there? We move the put, we move the call. So now if you are long a call and short put, that is going to act the same as if you are long stock. That is the equivalent synthetic position. And here it is. Let's skip this one. Long stock. Here's what it looks like. Let me grab this. Sorry. That's a long stock position. That's a long call and a short put position. Your P&L will mirror, done in the right ratio, they'll be exactly the same. So it really makes it a lot easier to understand the relationship beyond simply equities when you look at how the value of a put, the value of a call, the risk profile of a call, the risk profile of a put, and the risk profile of stock, how when working together, two can create the third depending on how you order them. Now let's talk about the options Greeks. I touched upon it briefly. In fact, I'm probably going to try, see if I can get this to show up, if I can share my screen. Let's go through these one at a time. Maybe we'll jump back and forth. The first of the option Greeks, the one that everyone would probably be familiar with, even if you're not an options trader, is delta. Now, it's funny because the company I work for, we go to a lot of really boring meetings, not CTU, my other job, and we have a couple of people who always like to say, use those work speaks, and delta is one of the things that they always like to say. And I'm like, you're not talking about the rate of change. You're not talking about the hedge ratio. You're not talking about the percent chance an option will expire in the money. You're just using it, in my mind, out of context. But what does delta tell you? Delta tells you at any point in time, how will movement of the underlying asset affect the price of your option? So in an example, if you have a delta of 50 for an option and you're long a call and the stock goes up $1, all things equal, the price of that option should go up 50 cents. It was a 50 delta option. The underlying went up $1. You would expect it to improve in price by 50 cents. So how will a movement up or down in the underlying affect the theoretical value of your options? So that's what you have to keep in mind. That's the first piece of options groups. What does it show you? Now, let me try to switch over, and I'm going to try to show you real quick. I'm going to try to show you. Okay, I'm going to just quickly share. This is my. There it is. So this is paper trading account. Let's put Apple in here. This is from. This is Thinkorswim. So if you look here on the left side, here is the delta of our options. So for example, Apple is trading at 94.25, up a little bit today, up 55 cents. So the 95 calls. What's the delta of this 95 call right now? Well, delta here, it's always delta runs 0 to 1 or 0 to 1.00. This delta is 40. So if the underlying moved $1, you would anticipate that this June 95 call would increase in value by 40 cents. So it gives you a way, and it's also a hedge ratio where if you had, again, I'm going to have to make numbers bigger just to make the math work. If you owned 10 calls to be what we call delta neutral, which would mean your position should not profit, all things equal, how would you hedge these options? You would sell, in a case where you own 10, you would sell 400 shares of stock against your 10 long calls to be what we call delta neutral, to put your position in a point at which if it goes up, the value of your stock will increase, your value of your underlying will increase, but the value of your stock will decrease, keeping your profit relatively, in theory, it would keep it exactly 0. The reality is there's always a little leakage one way or the other. But to hedge that, and as an example, if you owned these calls here, the 90 calls, and you wanted to hedge those same 10, you'd have to sell 900 shares of stock against your 10 long calls to be what we would call delta neutral, or have a position that is squarely hedged. The next thing we're going to talk about, and I'm going to try to bring it up here. Let me see if it'll give it to me. Okay, yeah, I like this better. The next thing we're going to talk about, I'm going to look quickly at the slide so I read the slide correctly. I'll stop sharing and I'll flip it back so we do it. The next piece of the option puzzle is gamma. Gamma is, I always like to say, it's the rate of change of the rate of change. It's the rate of change of delta. It's the override on how much will your delta change because it's not a static number as we increase. So in the previous example, underlying goes up $1 on a 50 delta option. Your delta of that option after the $1 move will probably be, and I'm making up a number. The price of the value of your option will increase by more than 50 cents because of the override factor. As it moves forward, as the price moves up or down, gamma on a positive way will make you longer, more valuable on the way up, and will make you shorter on the way down. It measures the velocity of the price change and the hedge ratio. So let me show you that real quick. I know we're up almost against 6:30. I want to make sure we get these last couple of points in for you guys. Here on Thinkorswim, we have delta, gamma, Vega, Theta. There is no row. But let's use this 90 line. You can see it's kind of small here, but gamma is 0.05. And what you'll notice is the gamma is highest normally at the money. So as close as we can get to where the options are, where the underlying's trading. So if we look, 92.29 is the at the money option. The gamma for this is 14. The gamma for the out of the money, the deep in the money calls is 3. The gamma for the out of the money calls is 6. So it's sort of on we would call it a curve or a smile The gamma does not move linearly. It moves in sort of it's a curve. And the closer you are to the at-the-monies, the more you will get gamma changing your delta. And if you look at as we look at delta here, the delta on the deep in the money calls is 92. The delta on the deep out of the money calls is 11. The other way to look at that delta is, what's the percentage chance that my option is going to finish in the money? I don't like to necessarily lean on that, but you will hear people talk about that, saying the delta or the hedge ratio is, what's the percentage chance right now that my option finishes in the money, above the strike that we're sitting on. So it's another way to view it. That's delta and gamma. Theta, which you'll notice is always a negative number. Theta is, and I'm going to go backwards, you'll see that they're small numbers and they're negative, and you'll notice that the Vega numbers on the calls are positive. So let's show you what theta is. I'm going to go back to I'm sorry, I'll go to theta first. Theta measures the effect of the passage of time. It is time decay. And when I mean it's always negative, it means that it always negatively impacts the price of your option. It always makes it worth less and less. Now, if you're short options, the passage of time is in your favor because you've sold an option at a certain level and now it's going down in price. So you're negative. You have a positive theta, which means it's going your way, but in and of itself, the measure is always negative. Options are always losing time value. There may be other factors that increase the overall value of an option, but time will decrease, and it doesn't decrease linearly. It decreases on a curve, which is why you'll see options trade weekly, because the effect of theta is increased, sort of compressing the trading of options. So theta is always negative. If you own options, time is always ticking away. The sand is going through the hourglass. You need those options to get in the money before expiration. And the longer an option just sits, it just becomes worth less and less. All things equal, you're owning it, and the options value just decays away. The word is decay, decays underneath you. So that's the effect that theta has on your option in this three-dimensional world of how do my options get priced. Then the last piece is Vega. And we talked, well, not the last, we have one more after Vega, but the last important one is Vega. It measures the effect in the change of volatility on the price of an option. I told you that the Vega is the one piece of the puzzle that's sort of, it's art as much as science. It's the one thing that can drive prices up or make them crash down because it's not constrained by underlying price. It's not constrained by strike. It's not constrained by month or expiration. It can be cumulative when you measure the risk of a portfolio of options. So you could be long volatility, short volatility. In certain months, you could be long it or short it. You can aggregate it to try to get an overall view of your risk. But most times, particularly with volatility, you need to identify the differences between, if you have number of months of volatility, you could be long one month and short one month and think, wow, I'm Vega neutral because I'm long July, but I'm short August. Well, yes, you may be Vega neutral, but that position is going to skew as you move towards expiration. So the Vega is the piece that we'll spend the most time about. It's the hardest to understand, and it's the most dangerous because it's the hardest to predict. And the last one is Rho, relatively small impact. It measures the effect of interest rate movement on your options. Now, as we know, interest rates have been locked in a low risk-free rate forever, it seems like, since December 2008. Prime hasn't moved. It can affect your position. You do want to understand the impact that Rho can have, but it's not something you have to actively manage. On a day-to-day basis, it's not going to be something that's going to put you out of business. I appreciate everybody being here with us today. I hope I gave you an insight into what you'll see at the end of the month when we start phase 1 of our new options trading classes. Tonight's presentation was brought to you by our good friends over at FXCM. If you're interested in FX, if you've heard me talk about FX in the past, please go over to FXCM. They bring you these webinars. They offer a phenomenal FX trading platform. The MetaTrader is just beyond what you can imagine for free. I use it for mine. I love using the MetaTrader. All the indicators are on there. We've got information at CTU if you want to learn more about FX. But we'd like to thank the people at FXCM. They're the ones that sponsored this tonight, brought me here into your living rooms or your offices or on your iPhones or wherever you're listening to me. So please make sure that you go visit their site. They brought this program to you tonight. I mentioned it earlier. I'll remind you again. The Silver Options Package, the end of the month, the 25th and 26th, both days at 5:30 and 7:30, so 4 hours of me. We're going to be talking about options. We're going to be talking about how they can help you grow your portfolio. And the last piece, the one I'm most excited, despite we're going to do kind of the basic stuff, we're going to kind of get into the nitty-gritty of how can you put these options to work for you, and we're going to talk about debit and credit spreads. I'm going to try to, as best I can, dispel a lot of the myths that are out there about debit and credit spreads and how we can get them to work for us. You get that. You get 4 hours, like we said. You get 1 year access to our recorded videos for more options. You get a month's access to the cyber group, which is in and of itself worth the price of admission. So for $97, follow the link. It should be going up on the bottom of the screen real soon. If not, I will try to reach up, grab it, and bring it back down. So, okay, I should be able to pull this, put it right there, copy, drop it in for everybody. We do not have a full course on options yet. It is coming. We hope that this will be phase 1. If there's interest, and we hope there is, we're going to have a phase 2 and a phase 3. We'll get to all kinds of fun stuffs like, you know, ratio spreads and butterflies and jelly rolls and boxes and condors and, iron condors and all those fun things, and talk about volatility skews and how can those things affect your trading and what you need to know, the real risks involved. I'm very much a risk-averse trader. I like to understand my risks before I worry about the profits, and that's where I'm going to be coming to you from an option standpoint. I'm not going to tell you, and I'm never going to put you in a position where you're putting more at risk than you understand. Understanding your risk is, I think, the first thing I need to do when teaching options is understanding, you know, where can you get burned, and I want to make sure you understand that. So please join us at the end of the month. There I am again. Oh man, my mom likes it. She's about the only one. Again, $97. Come join us. And I'm telling you, just simply being able to get to the cyber group for a month is worth the $97. So I hope everybody takes the opportunity to join. I'm going to stop recording, but I will try to answer any questions that pop up on the screen. So this is Greg McDermott for Cyber Trading University signing off. Thanks for being with us this evening. Everybody have a great night.